Tonight, it's my pleasure to welcome Joel Lutz from American National Insurance Company. Joel's company can help you with everything from regular homeowners insurance to landlord insurance, um, of course, auto life, and even stuff like builder's risk policies for us investors. So Joel's going to join us tonight and just kind of answer our questions about making sure that our assets are protected and give us a little bit of insights about the insurance industry.
Thank you for the introduction, Cassie. I'm going to jump right in here. What I'm going to try to do, insurance is not the most exciting thing, obviously. You don't need me to tell you that, but I'm going to run through here and really try to give you what I've learned, what I think are the highlights, what you need to know to be an educated consumer of of an insurance product for your investment, right? I look at it as I understand the insurance company's perspective, and then I have it from a consumer perspective too, and kind of seeing I see both sides, and both sides have logical reasonings for why they think certain things and why they want certain things. So I kind of play that middleman, right, in my daily job. But if I can give you all some pointers on how to best talk with your insurance person or ask those questions or whatever, hopefully we can do that for you here. Here's kind of the agenda. I'm going to go through each one of these, so there's no reason to go through that here. But yeah, so I've been doing insurance for 10 plus years here, starting back in 2009 when I got licensed. Currently, I'm the life and commercial specialist for American National here in San Antonio, but originally started out doing farm and ranch insurance, and that's kind of how I got introduced into landlording. I noticed that a lot of my high net worth clients, there was kind of a, repetitive that they all had rental properties of some kind, whether it was commercial or residential or what have you. They all own some type of real estate, right? And I said that can't be just coincidence that's the case. I learned later that it probably had a lot to do with taxes. Looking at it now, that's why they had bought and all of those. But anyways, I noticed that and kind of got the itch myself. Also, long-term care certified, and to have designation for retirement income certified professional. American National as a company, I have been with them as well, represented them pretty exclusively for 10 years. They run a lot of the rental owners policies that we do, but they're a Texas-based company out of Galveston, been around since 1905. As far as the investment side, I talked about my client base with the rental properties and how that kind of opened my eyes to what I maybe should be considering. But my wife and I have started back in 2018 and have 5 single family homes here on the northwest side. We do self-manage them. I handle more of the acquisition and rehab side, and she does a lot of the managing as far as getting tenants in and taking care of their requests and those type of things. So that's kind of where we're coming from. We try to work as a team on it as best we can. I'm going to look at some terms, some definitions, so we're on the same page as what these different things mean. Because you can look at 2 different quotes that you get, right, from 2 different insurance companies or even the same agent, and they can look exactly the same. They can have the same amount of coverage. So you have a $150,000 house, right? They're both showing $150,000 replacement cost for that. But based on the type of coverage that you have, they may be very different. And so the premium may look really good on one and it doesn't on the other. And the coverage may look the same, but it's actually not. So these are some of the terms that I think you need to know. First of all, here, personal and commercial lines. So personal policies, don't get confused with that term. You can't have an LLC. You can't have a personal policy that has an LLC if you do have that as the owner of that policy. But typically those are 1 to 4 unit properties, right? So your single family, your duplexes, your triplexes, your quads, that can all go on a personal type of policy. For a lot of carriers, carrier being insurance company, there's personal policy limits that they'll do. Most of them is 10 that you'll be able to do with any one insurance company, usually on the personal side. At that point, you either have to go to a different insurance company or you would have to start a commercial policy, a single policy. The personal ones are nice because they're standalone. So it's just that house, that location, and they're typically long-term homes that you have, long-term rentals that you're putting on these personal policies. I say that there have been some changes here in the last year or so. I'll say that the short-term rental has become so popular that these personal lines companies are trying to find a way with endorsements and those type of things to make the short-term rental a little more viable on their policy. And it's the liability that they're mostly concerned about, being sued for someone that doesn't live in the home normally. They're visiting, slipping and falling or hurting themselves or somebody else doing so. That's what they're concerned about. But that is loosening up a little bit as far as whether they'll do just long-term rentals or short-term as well. On the commercial side, this is a single policy that you can put multiple locations on typically. They have a little bit of an easier time adding them because you already have the policy established. You're just adding a location to that, adding that house or that duplex or what have you. They do have a shared limit of liability. So typically you'll have like a $1 million per occurrence limit on your commercial policy. And you can have that too on a personal policy, but on a personal, that one location has that $1 million liability limit. If you have a commercial policy with 10 locations on it, 10 different homes, let's say, they're all going to share that $1 million limit. So sometimes that's when people look to add an umbrella or some different type of coverage there for that. And when I'm saying the 1 million liability limit, I'm talking about the liability, the actual chance of being sued, right? If you're sued or something like that, dealing with it, not the actual property coverage itself. The last thing I'll note about the commercial policy, if you're doing financing with these with a traditional bank and one that typically does single family homes, primary homeowners, those type of things, the commercial policy can be challenging because they don't understand how to read that policy. They're used to seeing the standalone policy on the personal side where it says, here's the location, here's the bank, here's the coverage, here's the premium, right? They're used to seeing that. If you give them a commercial policy with multiple locations on it, sometimes it can blow their mind and we got to jump through some hoops to make them understand that. So I say that just because you don't necessarily, commercial sounds easier and better sometimes, but jumping to that initially can cause a little bit of a headache, especially if you're financing those. Next thing, replacement cost versus actual cash value. Two different types of how you will actually be paid if a claim comes about, right? So typically everyone would have or want to have, desire to have replacement costs if their property is justified in having that. So that's going to be the cost to repair or replace whatever is damaged, right? So I use the example of the roof. So here in San Antonio, typically for the homes that we're buying for buy and holds, somewhere between $120,000 and $150,000 worth of value, and then about 1,000 to, at the most maybe 1,500 square feet. You're looking at about $10,000, $8,000 to $10,000 for a roof replacement. So let's just say it's 10 for round numbers. You have $1,000 deductible, $10,000 is what it's going to actually cost to have a roofer come out there and replace it. Well, that means that the insurance company at replacement cost is going to give you that $10,000 minus your $1,000 deductible. So you'll get a $9,000 check to replace that roof, right, in that case. That's ideal. Same thing if, God forbid, the entire house went away in another event, right? They're going to give you replacement costs to build the exact same house back, what it would take, up to your policy limit. Actual cash value is a lesser coverage. So actual cash value will take into account depreciation. Depreciation typically is always based off of the age of the damaged item. So same thing in the roof. So say it's a 20-year roof and it's 10 years old, right? So they're going to depreciate it by 50% if you need to have that roof replaced. So then that same $10,000 roof is going to cost $10,000. They're going to depreciate it by half because of depreciation. So you'll get $5,000 minus your $1,000 deductible. You're going to get $4,000 for that roof in that case. So if you can, you'd want to get replacement costs, right? Because it's a better coverage. But not always do we qualify for that based on the condition of the property, right? An insurance company is not going to just write a replacement cost policy on a house that isn't justified in having that. So as long as they're in a good quality home, replacement costs should be easy to get. But make sure when you're looking at the quote that you are getting replacement costs over that actual cash value if you can do it. And sometimes too, I will note that if you have an older roof, they'll do replacement costs for the house, but the roof will be actual cash value. In the example, they can actually break that out so that the home actually has replacement costs. But if the roof is older or in poor condition or what have you, sometimes you have to do actual cash value on it because the insurance company won't give it to you, right? If that's not an option. Looking here at some different types of what they call policy forms or coverage forms is what these are sometimes called. These are specific to Texas just because I have this TDP1 here, but The broad and the special coverage that you see there, that should be a pretty national term if you're buying any properties in other states, those type of things. Basic being the lesser coverage, special being the best. There is one in the middle called a broad or TDP2. I typically don't even consider that one because if you qualify for the broad, you can get the special, so might as well get the better coverage in that case. So a TDP1 is Texas Dwelling Policy, is what TDP stands for, and that was a term that they used quite a bit, about 15 years ago or so, but they've kind of gone away from that because they've gone to more national forms, so it's not a specific Texas policy, but still a lot of people and older mortgage companies know that term, and that's what they ask for or go off of. So typically we're always trying to do the special coverage, the TDP3, Texas Dwelling Policy 3. But as far as definitions go, a basic policy is going to be what's called a named peril policy. Coverages are only for things that are named on the policy. If it's not named on the policy, it's not covered. So a typical named peril policy will have the items that you see listed there and nothing else. That's usually what comes with them. Luckily, it's most of the big items, right, that most of us are worried about: fire, lightning, the windstorm, and hail are typically the big ones. But things that it doesn't cover are like pipes breaking in the wall. That's not covered on there. Plus a number of other kind of small things we don't necessarily always think about is not on that named peril policy. So kind of like the difference between actual cash value and replacement cost, the basic is a lesser coverage. Typically, you only go with that if you have a home that's in a condition that the insurance company is requiring it to be there, or for premium reasons, or maybe you're not that concerned about paying the extra price for special. That could be another reason too. You're definitely justified in doing that, as long as you're aware of what you're getting there. So on the special side, it's almost the flip side of that coin of what basic coverage is. It is all perils except the exclusions are listed on the policy. So the only thing that's excluded from the policy is what's listed. Everything else that's not listed is covered on the policy, right? So typical exclusions are what I have listed there: ordinance or law, earthquake, flood, all those things that typically aren't covered on any type of property coverage. But yeah, that's a much broader form, if you can see that, of coverage, because it's covering everything else, right, than what's actually listed there as an exclusion. Hopefully that makes sense, but they're literally flip-flopped on how they look on the policy. These two, when you're looking at a quote, can look very similar. You want to look for this special coverage or some other type of something that's indicating the type of coverage form that you're on. Should say at the very top of the quote, typically. I will say that when you have basic coverage, typically actual cash value is coming along with the basic coverage form. So you're going to get actual cash value when you get this basic coverage here. When you're getting special, you're typically always going to have replacement cost coverage with that special coverage you see there with that. So they kind of go hand in hand. Replacement cost with special, actual cash value with basic is pretty standard, that those two follow each other. Some other coverages that'll come on your renter owner's policy, just to make sure you're aware of. You're going to have other structure coverage. Typically, it's always 10% of whatever the dwelling coverage is. So that's that same $150,000 house that you have covered. 10% of that, $15,000, would be for your other structures. So a detached pergola, if you got a shed in the backyard, things like that. I know typically on a lot of rental properties, the landlord, we're not providing those things, but if they come with the house and it's back there already, obviously you're not taking those things away. But sometimes people do have some pergolas built or other things that were there by the previous homeowner, and there will be coverage there for that on most policies. A big one there, loss of rent. That's paid as part of a larger claim that you have. It's got to be a covered peril that causes that loss of rent. A pandemic is not a covered peril. So if you've lost rent because of that, your insurance company is not going to pay for that loss of rent. But if you have a kitchen fire and your kitchen's being repaired, right, and the insurance company's paying as part of that claim, they're going to pay because your tenant can't live there, right? Well, your insurance company is going to pay for that loss of rent for typically up to 12 months is the max that they'll pay it. A lot of policies will say actual loss sustained. And that's just where you have to provide what the rent has been, over the last 6 months or whatever, and then they'll figure those numbers out based on the number of days that the tenant has to be out of the home, right? Some of them do set a limit, but as far as the amount of coverage that they'll pay, but typically it's a large enough number that you'll never get to that point within a 12-month period on that. Then the liability, we've spoken that a little bit already, but the liability is a big part of that, protecting yourself from lawsuit, right? We see a lot of people here, at least I do, that are forming LLCs to hold some of their properties in. It definitely helps. It's not a guaranteed protection. Attorneys are very good at finding ways around that, but it's another layer of protection. So we are seeing that, and people are putting multiple properties into an LLC coverage there. Umbrella is another thing that we talk about, and that term is thrown around a lot sometimes on the property coverage side. But umbrella does not cover anything with the actual house itself. Umbrella is strictly liability protection for you, your entity, and the assets of that entity. Meaning that if you get sued and your underlying policy, say you have a underlying policy with $500,000 on it, and God forbid there's a bad lawsuit and that gets used up, right? Well, then your umbrella policy is going to kick in and start paying up to the umbrella limit. So it's an additional policy that provides strictly liability coverage to protect that entity. The one thing to note is that there has to be, you can't put multiple entities on one umbrella in most cases. There are some ways around that, but typically if you have 10 properties in one LLC and 10 in another, there's a good chance they're going to require you to have two umbrellas because you're covering two different entities there with that. So that is kind of a little more company dependent, depending on who you're working with on that end. But the liability coverage, we're seeing a number of clients with multiple properties that are doing these standalone umbrellas. And it's also wise to have one personally. So you can have one for your LLC, but we have clients who have two, right? So they're personally with their home, maybe they have a boat or definitely their cars and those type of things. Personally, in my opinion, from a risk standpoint, what I've seen is your biggest risk of being sued or a large lawsuit stems directly from your auto. And the chances of something happening at your primary home where you're gonna have a big claim, or at a rental property where you're gonna have a big liability claim, pretty small. But the chances of, God forbid, something happening and it, changing the radio station and a bad accident happens, right? And you're at fault of it. I've had them happen. And the medical expenses and the attorney's fees and those stuff add up really quick. So to me, your biggest risk is personally on your auto that you're driving around. So having just a personal umbrella, if you have assets in your personal name or not, would be a good idea, because you want the insurance company on the hook for that bill to fight for you and provide attorneys and those type of things when you don't necessarily want to be on your own dealing with that. So as far as insurance considerations, when getting home or different options that you have when you're looking at the initial purchase. So it all depends on condition, right? So are you buying one in really rough shape that's going to take 2-3 months to fix up? Well, the insurance company is not going to write or want to write a special replacement cost policy on that house because it needs a new roof, it needs painting. The exterior needs painting, it needs plumbing work, it needs this and that. Well, you may not be able to qualify for that, but you can get like a builder's risk policy for renovation, those type of things. And there's different variations based on the amount of work that you're doing. Are you leveling the foundation? Are you moving walls and those type of things? Structurally, that's a different type of policy than if you're just going in and doing floors, paint, maybe replacing the roof or something like that. So visit with your agent or whoever you have helping you with that. And if they have a better idea of what you're doing, I know Cassie always knows, I always ask her, 20 questions about what she's doing with a house. And I think sometimes you're like, I don't know yet. I haven't figured that out. And I realize that may be the case, but think about where you're most likely going to go and try to let that insurance person know that so they can advise you on that. In Texas, a 60-day vacancy is something that comes on a lot of policies. It's a clause, if you will, within the contract on some policies that we write. That the builder's risk doesn't have this and some other ones don't. But If you're trying to squeak by and saying, well, I'm not doing any work, I just want the regular policy, because the regular, occupied policy is cheaper than the builder's risk. So a lot of times people want to go that route initially, but they have a 60-day vacancy reduction or clause that reduces some of the coverages on that policy. Depends on the carrier, but sometimes they'll have, in our case, we'll reduce coverage for vandalism, malicious mischief, a pipe breaking or water damage within the house. We'll reduce coverage because if there's nobody there to see that or stop that, or the damage can get significant very quickly. Some carriers will change your coverage at that 60-day mark of it being completely vacant from replacement cost to a actual cash value, right? They'll make that change. So it kind of depends on the carrier and the policy, but a lot of them have that within that. You can buy that coverage back, meaning you can add an endorsement that takes that clause away. I will say that most of our clients who have a occupied home are not buying that endorsement, though. It costs about $80 a year, depending on the value of the home. For us, looking at the heating system, because these are going to national policies, their guidelines that they have within them typically require a thermostatically controlled heating system of some type. And a lot of times they want to see a central type of system of some type to get the best policy and the best rate, I'll say. You can definitely still get policies. You can get good policies, but to get the best rate, they're typically looking for thermostatically controlled at least. And they're also looking sometimes for the central system on that being a requirement of something they're looking for. The thought process behind that is not necessarily for us here in Texas, but northern states. If someone's not there and they forget to turn the heater on, storm comes in and there's not a thermostat, right, to turn the heat on, well, you can bust pipes and cause some major damage there with that. Also, if you don't have a central system, right, people are individually heating their homes in all kinds of ways that they can figure out, right? So that's where you have the fires from the little personal heaters and things like that. So it stems from concerns about water and fire increased risk, right? The roof, age and condition of the roof are becoming a much bigger issue, or not issue so much as a concern for the insurance companies, because they're buying a lot of roofs due to hail and wind damage and the storms that we've been having really countrywide. But specifically here in Texas, we've seemed to have a couple every single year that are pretty significant. And the older the roof, the worse the condition of the roof, it is much, much more susceptible to damage from even small hail or light, smaller winds than a newer roof or a roof that's been well cared for and is in good condition. So something I'm telling all investors to do is, if you're buying a new house, let's say you've negotiated a new roof, or the seller put the roof on maybe 2 or 3 years ago, awesome. And we can get you a huge discount for that, even using the seller's disclosure statement, right? It's a legal binding document, and underwriting will take that to give you the big discount. But I'm also telling people, if you can, get the invoices on that, because it's coming with the manufacturer's warranty on the roofing material. But also, if it's a reputable company, the labor has a warranty too. Sometimes 5 years, maybe even 10 years on that. And if you have an issue where you get some water coming in somewhere, and the insurance company comes and does an inspection and says there's no damage to your roof, that's an installation error. That's something's wrong with the way the roof was installed. They're not going to replace that. They're not going to fix that. That's not their problem. There was no covered peril that caused that. So you're going to turn around then and go to the roofer and say, hey, I need some warranty work done, right? Rather than that coming out of your pocket. So if you can get those invoices, I recommend it. Try to help yourself out there with that down the road. Protect yourself. So also on the roof, there's been a lot of, when looking at policy and the different policies, options that you have, they're changing these to where they're, sometimes they'll do full replacement cost coverage on a roof for 15 years. And then after that, they won't cover the roof anymore. Sometimes they're doing a schedule. It's kind of like a depreciation schedule, but they tell you every single year that the roof gets older, we're going to take, I'm using an example, 2 or 3% off of what we will pay you for that roof. Because, and I'm talking about asphalt shingle, I should have said that, but for asphalt shingle, because they depreciate and they do wear down, these are what these are applying to. Sometimes they'll do the actual cash value, which we talked about before, and then sometimes they'll just exclude it if it's in poor condition. They will just straight up say, we're not going to pay for that roof until you have it replaced, and then we'll add it to replacement cost or we'll do what have you. What they're not wanting to do is take over a roof in poor condition that's going to need to be replaced the very next storm that comes through. They want to be able to be on a risk, collect some premium on that, and then, have a storm that justifies needing a new roof. They're trying to figure out a way to make that profitable for them because they got to make money, and but they're paying these claims pretty heavily the last couple of years, so they're really buckling down on that. So just be aware of what your policy says. If it's a good agent, they should be pointing that out to you and showing that to you. But I've seen people who don't know what they have and don't realize that they've got to reduce coverage on that roof until we point it out to them. And the last thing I'll point out here too is claims frequency. This becomes a bigger issue when you have multiple properties and trying to add some more to your portfolio, right? These insurance companies are looking at not only the size of the claims, but the frequency, because for them, if you have 2 or 3 claims in a row, you're going to have a propensity to have more claims, right? That just shows, and it's statistics that are showing this, right? They'll go back and show us all these graphs and all that stuff, but they're looking back 5 years. So literally your claims history of the last 5 years. Have you had 1 claim? No big deal. 2 claims? Not a big deal. If you start getting 3 claims, that type of stuff, they're going to start asking questions. You're going to have a little bit of a harder time getting policies with the best companies with the best rates, because they're going to be more stringent on their underwriting, and they don't want you if you're having 5 claims in 5 years, because that means, guess what, next year they may have a claim that they're paying on you. And even if they're small, that doesn't necessarily mean anything, because the next what they're thinking is, well, the next one's going to be big, right? The next one will be a big claim. So we talk to clients typically a lot about is it worth it, right? Do you have a $1,500 deductible and this is a $1,800 claim? You're going to get paid $300 on that. Is it worth doing that? Probably not. We're going to advise you not to do that, depending on the situation, right? Everything's very situational. But if you're going to get $300 from the insurance company, there's going to be a claim go on your record for something. Personally, I wouldn't be doing it. And that's how I present it to people. Say, hey, if it was my property, I'd bite the bullet and pay the $300 because the full amount, because it's not worth getting that to have a claim on my record. The claims that do affect you the most on the homeowner side is going to be fire, theft, and water. So weather-related claims are easily, we can negate those and get around those with underwriting. But ones that we've actually had a fire at the house, a theft from a residence, or a water loss, typically water break, or sometimes even appliances and stuff like that will leak. Those are seen as a higher risk item than other weather-related claims would be. Tenants need coverage as well. This is something I think is really important that sometimes isn't talked about enough. That all the apartment complexes, reputable apartment complexes here in San Antonio, at least I know, and around the state, where we have clients that live, require a renter's insurance policy. It not only protects them, it protects you, and that's why the apartment complexes are requiring it. They're not requiring it because they're nice people and want to look out for their tenants necessarily. There's a self-serving part of that as well. But a typical renter's policy is going to cost them anywhere from $125 to $175, depending on how much coverage they do. I mean, they could do a bunch and it costs more, but typical ones are somewhere between $125 and $150 a year for that. So what's it going to cover? Contents. Their contents, right? So in your rental house, you don't own their clothes, you don't own their furniture, those type of things. So God forbid there was a kitchen fire, right, that we talked about earlier, and all their kitchen stuff burned up, right, as part of that fire. Well, their tenant's policy is going to pay to get that stuff replaced for them. The same way you had loss of rent coverage, the renter's policy has loss of use coverage. You have this, if you have a homeowner's policy, you have loss of use coverage as well on your homeowner's policy. And same example of the kitchen fire, right? They can't live there because you are repairing it, right? So they're having to either find a place really quickly or stay in a hotel or what have you, which is almost certainly going to be more money than what they were paying you on a long-term lease at that house, right? So that extra expense, let's say their rent was $1,500 a month, and it's costing them $2,000 a month to stay in a hotel while it's being repaired. That $500 difference is going to be picked up through their loss of use coverage to reimburse them there for that. They're going to have personal liability and medical payments on the policy as well. So, if something happens there at the house, they get sued. Their policy is going to be primary on that. and start picking that up. You want that to be, that's why the apartment complexes are doing it. They want that liability coverage so that that renter's policy will hopefully take care of all the small stuff that could happen. And then if it's a big issue or what have you, and they get brought in, well, then they have their policy to back them up on that as well. We're recommending, we don't really do renters policies for just random people. We can do them, but within our agency, we're doing them for kids of clients or clients who are moving or have a rental house that they go stay at the beach or what have you. We're typically recommend that they go to their current auto insurance provider because they can get a discount. They get the bundle discount or what have you. So get them some savings on both of those, have them together. Even our own tenants, we don't, within my agency, we don't write any of their policies. We have them go elsewhere. I don't want that muddy that water at all with that. So we recommend the exact same thing to them. And then finally here, asking to be listed as an interested party on the policy. Apartment complexes are requiring this as well, and in my opinion, so should you. Reason being is it notifies you if the policy is canceled. So when the policy renews, you get notification of that. And if they don't pay their premium and the policy is going to cancel, you get notification of that, required to be sent to you by the insurance company. So, just like auto insurance here in Texas, it seems like there's a lot of people who will buy a policy and then cancel it the next day. Well, they got the ID card, right? They've got the proof of the policy that they sent to you. And so now everything's good and they're not going to pay on that policy anymore. Well, if you have listed as an interested party, you get a letter in the mail from the insurance company saying this policy was terminated. And, it might tell a reason, it probably won't, but at least tell you that this policy is canceled and give you the date that it's canceling so you can reach out and rectify the situation on that. By being an interested party too, it doesn't give you any rights to their contents coverage or anything like that. It's simply a notification of the policy's existence, more or less, is what it is. So. All right. I have this slide here. I did the same presentation last year. They were asking for some life insurance information in COVID-19. And this last part down at the bottom, they thought was interesting because of assets, right? We're all trying to accumulate assets to build a net worth, to have cash flow and all that good stuff. So I have these 5 bullet points here of life insurance, can be looked at as an asset, not only protecting your family assets, right? If something were to happen to you or the breadwinner, right? That's number one. But also protecting your insurability, your ability to get a life insurance policy or disability insurance or something like that because you're in good health. If you get it now when you're in that good health, you protect that insurability, your ability to get that insurance when later on there may be a health issue or something like that that keeps you from getting that policy. Life insurance can a lot of times help with getting loan approval, especially on bigger loans. If you're doing commercial things, commercial policies, not commercial policies, commercial loans, having a life insurance policy to provide as some type of collateral or protection for the bank if something happens to you, it helps out a lot in that situation. And then I talked about a lot of these new life insurance policies include living benefits for things like chronic, critical, and terminal illness. I have those mentioned there in the middle and examples of what that is. But you actually, if you have that, you can access your policy benefits, your death benefit in essence, and still be living, right? It's a living benefit. So that keeps you from depleting the assets that you've built up as well by having one of these policies that kind of kills multiple birds with one stone, which is what I'm a huge, huge fan of. The last one here, which they were interested, they thought was funny, didn't really know that it was as big as it is, but it has become a much bigger deal, in my opinion. At least I'm seeing a lot more in the last 3 to 5 years here. But life settlement companies. So if you have a life insurance policy, maybe you get up in age and say, well, I don't need it anymore. I don't want it anymore. I've got all these assets accumulated now. My family's well taken care of. Or what have you, or I just can't pay for it anymore, right? Well, rather than just letting it go or canceling it, these life insurance settlement companies are buying these policies from people. And so you're actually selling them your policy. They become the owner of it. You're still the insured, right? You're the insured life that they have on there, but now they're paying the premiums and they collect the death benefit whenever, God forbid, that time comes for I want to say for you, for me, let's use me as an example, right? So something I sell into two life settlement companies, and then I pass away. Hopefully I'm going to be 110, right? So at that point, then they actually get the death benefit. But when I sold them my policy and they took over payments, they're actually going to give you a lump sum of money. What that is totally dependent on the type of policy, the how much the coverage amount is, your age, all of that good stuff, your health. They take that into account. But if you have it, it could be an asset in that way to where you can sell it to one of these life settlement companies online, or I think there's even local offices here that do it here in San Antonio. So that is all I have. Hopefully that was helpful. Our physical office here in Helotes, which is northwest of San Antonio, is where we're at. That's my contact information, office phone, email, if you want to shoot me a question or what have you.